Hello everyone. Today, me and my teammates are going to present our project, which is the effect of interest rates on the housing market. So, let's go. For the introduction, interest rates are the percentage fees imposed by lenders on the amount of money borrowed. When individuals or businesses borrow money, they are required to pay interest to compensate the lender for the use of their funds. Conversely, banks offer interest rates as a form of compensation to individuals who save money with them. The specific interest rate applied to a loan or line of credit can vary based on various factors. Next, having a fundamental understanding of interest rates and the factors that influence them can assist individuals in making informed decision when it comes to mortgage loan. Mortgage loan are available in two main forms, which is fixed rate and adjustable rate.
Next, I will present about background of study. Variation in interest rate are acknowledged as one of the major elements affecting the performance of Malaysia's housing market. Mortgage rates are directly impacted by interest rates, and this has a big impact of how affordable house is for potential buyers. Changes in interest rate can also affect the demand for housing, and due to rising our home prices and low interest rate, an increase in mortgage lending has resulted allowing customers to spend more money at a faster rate thanks to rising in income based on Hashim 2010. As you can see, there are two figures of interest rate, which is table of interest rate in Malaysia and graph line of interest rate in Malaysia from 2009 to 2019. Based on the figure 1.2 in 2009 is the highest interest rate, which 11.8%. Highest interest rate will cause mortgage payment more expensive and reduce demand cause downward pressure on house prices. In 2010, there are negative interest rate of negative 2.1% where borrowers effectively paid back less than the original loan amount, and by lowering the overall cost improve affordability. In 2012, earning 3.7% shows that positive interest rate raise borrowing costs will cause force homeowners to make larger mortgage payments by lowering their purchasing power and housing demand.
Moving on to research issues, for many investors, the real estate industry is appealing and rewarding due to its size and scope. But for the past few years, the skyrocketing cost of real estate has been a hot topic among Malaysians. But given the current economic climate, will home prices start to decline or stay unchanged? The real estate market undergoes reform and constant shifts every year, much like the rest of the world. As a result of rising inflation brought on by higher oil prices, central banks around the world have to boost their policy rates. Increased interest rates will also increase the cost of home ownership since they have got a tendency to affect home values. This is particularly true in Malaysia. The state of the economy as a whole are determined by few elements includes GDP, employment figures, government policies and subsidies has a significant impact on the value of real estate. In Malaysia, the economy is currently slowing down and the ringgit is losing value while the cost of living arise. House prices are rising at slower pace while real estate purchases and building construction are drastically slowing down. According to JPPH, the Malaysian House Price Index rose by 5.4% in quarter 3 in 2015 compared to quarter 3 in 2014. To conclude, the state of the economy has a direct impact on home sales and price.
Objective for this study is, first, to examine the relationship between interest rate, gross domestic price (GDP), and house price index (HPI). Second, determine whether changes in interest rate, gross domestic price lead to changes in house prices index. And lastly, examine the effect of interest rate gross domestic price on housing prices.
For the literature review, based on Abdul Latif et al., the present study explores the factors that influence a housing price in Malaysia with the aim of providing valuable insights for governments, financial institutions, and consumers. The findings of this research are expected to hold significant importance for these stakeholders. Based on Alom, in his study, the study identifies the primary cause of unsold housing units in major cities in Malaysia as the mismatch between housing market demand and supply. Other than that, the research conducted by Ismail et al. Forecasting results demonstrates a close alignment between various house price index and predictors, indicating that house price can be determined and predicted up to 1 year in advance. Based on the study conducted by Hoi Lian and Russell Smith, the primary finding of this paper suggests that certain REITs, real estate investment trusts, exhibit a well effect, while others demonstrate a feedback effect.
For methodology based on 3.1, which is data description, which is to analyze the factors that influence interest rate on housing in Malaysia, specifically the home price index, interest rate, and gross domestic product. The observation is 10 based on annual time series, and the years we take is 2009 until 2019, and the sources is based on the World Bank. For 3.2 theoretical framework, there have two variables which are independent variables and dependent variables. There have two independent variables based on interest rate, gross domestic product, while for dependent variable is price house index, HPI. And 3.1, according to interest rate, is the amount a lender charges a borrower, and it is expressed as a percentage of the principal or the loan amount. High interest rate increase the cost of borrowing, and based on Amadio 2022, reduced housing costs and low mortgage rates both increase demand for real estate. For 3.2.3, gross domestic GP is the total monetary worth of all complete goods and services produced within a nation's boundaries during a certain time period is known as the gross domestic product GDP based on Fernando 2023. And 3.2.4 use a linear regression model to estimate the impact of interest rate on housing price. And the functional model for HPI is HPI equal to beta 0 plus beta 1 time interest rate plus beta 2 time gross domestic price plus error term, where each HPI represents the house price index, which is the dependent variable in the model, and beta 0 represents the intercept term, where interest rate is 0 is the intercept term, also known as the constant term, and beta 1 is the coefficient associated with the variable interest rate. It represents the estimate change in HPI for a 1 unit change in the interest rate, assuming other factors are held constants, and beta 2 is the coefficient associated with the variable gross domestic price. It represents the estimate change in HPI for a 1 unit change in the gross domestic prices, assuming other factors are held constants. And E represents the error term, which captures the unexplained variation in the house price index that is not accounted for by the independent variables.
Next, the ordinary least square, known as OLS, is statistical technique used to estimate unknown parameters in a linear regression model. For the Jar-Quebera normality test, which belongs to the category of Lagrange multiplier test, is employed to assess the normality assumption in statistical analysis. For the Bruce-Godfrey serial correlation LM test is employed to examine the presence of autocorrelation in the errors of a regression model. This test utilizes the residuals obtained from the regression analysis of the model under consideration. For the heteroscedasticity test occurs when the standard deviations of a predicted variable vary across different values of an independent variable or over periods. Next, multi-collinearity test refers to a presence of strong correlations among two or more independent variables in a multiple regression model. For Q-sum squared tests are utilized to evaluate the stability of coefficient in a multiple linear regression model. These tests rely on a series of cumulative sums or sums of squares derived from recursive residuals, which are standardized one step ahead for case errors calculated iteratively using subsets of the data. The last one is granular causality test. It's a statistical approach used to examine the causal relationship between two variables within a time series. This method employs empirical data sets to identify correlations, patterns, and provide probabilities understanding of causality.
The linear model has a coefficient of variation of 0.142815, indicating moderate variability. It serves as a baseline of comparison. The double log model demonstrates the lowest coefficient of variation, indicating the most stable and predictable relationship between the variables.
According to ordinary least squares, probability for dependent variables, which is the price index, is 0.9079, while the independent variables, which are interest rates and GDP, recorded a probability of 0.1941 and 0.1463 respectively. R square for this test is 0.2464 with 36.68 in SE regression and 1.038 F statistic. We can conclude that when interest rate increase 1%, price index will increase 11.77%. When GDP increase by 1%, the price index will increase as much as 21.35%. The probability of Jacobera is 0.6368, which is bigger than the significance level of 0.05. This means that we accept the null hypothesis and we can assume that the residual of model is not normally distributed. To determine the serial correlation problem of error in regression model, we use the Bruce-Godfrey test. Based on the results, the p-value is 0.0840, which is slightly higher than the significance level. Therefore, we accept the null hypothesis and assume that there is no serial correlation problem of error.
Stability test. Stability test assess if the relationship between a variable in a statistical model remains consistent over time. They help researchers determine if the model's interactions are stable across different time periods or datasets. Q-sum and Q-sum square test. Q-sum and Q-sum square tests are used to check the constancy of model coefficient over a specific time period. The Q-sum test look at cumulative sums of recursive residual to detect persistent shift in coefficients, while the Q-sum square test examine cumulative sum of square recursive residual for square change in coefficient. In this test, if the cumulative total line deviates beyond the range defined by the red lines, the null hypothesis is rejected, indicating high instability. However, if the cumulative total line stays within the region between the red lines, the model is considered stable. Granger causality test. The Granger causality test determines the causal relationship between two time series variables. It helps identify if one variable can be used to predict change in another over time. The test compares the null hypothesis, which assumes no causal relationship, with the alternative hypothesis, which suggests a causal link. To determine causality, the significant level, usually 5%, is used. If the p-value is less than significant level, the null hypothesis is rejected, indicating the presence of a Granger causality. However, if the p-value is greater than 0.05, the null hypothesis is not rejected, indicating no evidence of one variable causing another. In conclusion, stability tests help assess the consistency of model relationship over time, while the Granger causality test determines the direction and strength of causation between variables in time series data.
According to the result, the relationship between GDP and interest rate is negative and significant. However, the relationship between GDP and price house index is positive and insignificant. Based on multicollinearity test, there is no multicollinearity problem because all the explanatory variables have a lower center BIF, thus all explanatory variables are moderately correlated. The Kusum and Kusum square test show that the model is stable as there is 5% significant level, even though it is clear from examining the graph that the cumulative total line is located within the region that is defined by the red line. This is the case regardless of the significant level. Therefore, there is not enough information for us to conclude that HO should be rejected. Consequently, we are able to reach the conclusion that the model is stable. The relationship between the price house index, interest rate, and GDP has important policy implications. A high price house index indicates a strong housing market which can contribute to economic growth and wealth creation. However, it may also lead to affordability challenges and financial instability. A low interest rate stimulates housing demand but can fuel asset bubbles. On the other hand, a higher interest rate can curb inflation but restrict housing market activity. Policymakers must carefully manage these variables to maintain a stable and sustainable housing sector that supports overall economic growth while minimizing risk. That's all from us. Thank you.